Hey, stop scrolling. Because if you're looking to build passive income with REITs, this is the video you really can't afford to miss. Mapletree Logistics Trust is paying a fat 6.9% dividend yield, but is it actually a bargain? Or could it be a value trap? We'll break down everything, from rental reversions to Fed rate cuts, and whether now is the right time to buy. Oh, and make sure you hit that like button so more Singaporeans can discover this video. Don't forget to subscribe to Wealth for You, the place where we help you invest smarter, one bite at a time. And hey, stay till the end, because I'll give you my personal take on whether MLT belongs in your portfolio right now. Just a quick disclaimer. This video is for education and entertainment only. It's not financial advice, so always do your own research or speak to a licensed advisor. Part 1. What are REITs? Alright, let's dive in. A REIT, or Real Estate Investment Trust, is kinda like owning a small slice of a giant property empire. Instead of buying a condo or office space yourself, you simply buy REIT units on the stock exchange. And in return, you get regular dividends, just like collecting rent. But here's the best part. No tenants, no leaking toilets, no chasing after late payments. It's just passive income, without the landlord headaches. Part 2. What is Mapletree Logistics Trust? Now let's move on to Part 2. What is Mapletree Logistics Trust, or MLT? Well, let me introduce you to one of the giants in Singapore's REIT world. MLT was actually Singapore's very first Asia-focused logistics REIT, and today it owns a massive portfolio of 180 properties spread across 9 countries. We're talking about Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam, and India. But don't picture shopping malls or sleek office towers. These properties are really the backbone of e-commerce. Think warehouses, distribution centers, and logistics hubs. In fact, the next time you receive a Shopee or Lazada parcel, there's a good chance it passed through an MLT facility somewhere in Asia. Now let's break it down. Total property value, an eye-popping 13.3 billion Singapore dollars. That's billion with a B. Occupancy rate, a solid 96.2%. That means almost all their properties are leased out, which is exactly what you want as an income investor. Rental reversion? This tells us if MLT is renewing leases at higher or lower rents. The good news? In Japan, plus 15.7%, Singapore, plus 7%, South Korea, plus 4.7%. But here's the challenge. In China, minus 9.4%. So rents there are falling, and that's dragging things down a bit. So overall, MLT is strong in most markets, but its China exposure remains the key risk. All right, Part 3, FY 2024-25. Financial results. How did MLT perform? Let's talk numbers, and what they actually mean for us investors. For the financial year ending March 2025, here's how Mapletree Logistics Trust did. Revenue came in at 727 million Singapore dollars. That's a slight dip of 0.9% compared to last year. In other words, income from their properties fell just a little. Nothing dramatic, but worth noting. Net property income, or NPI, basically what's left after operating costs, was 625 million Singapore dollars, down 1.5%. This shows that operating efficiency is still intact, even though there's mild pressure from weaker rental markets, especially in China. And here's the number income investors care about most. DPU, or distribution per unit, was 8.053 cents for the full year. That's a 10.6% drop from the previous year. So yeah, the payout shrank. But let's put this in perspective. It's not a free fall. This isn't MLT crashing and burning. It's more like the REIT catching its breath, dealing with higher interest costs, currency effects, and China's economic slowdown. The fundamentals? Still strong. The payout? Still consistent, just trimmed for now. Part 4. Is MLT undervalued? Let's look at the numbers. All right, let's see how Mapletree Logistics Trust stacks up in the market today. MLT's market cap is sitting at around 6 billion Singapore dollars, making it one of the bigger REITs on the SGX. That size gives it stability and scale. Now, the trailing PE ratio, which is based on past earnings, is about 32 times, which, honestly, sounds pretty high at first glance. But if you look at the forward PE, it's more reasonable at around 19 times, assuming earnings recover. Now, this is where it gets interesting. MLT is trading at roughly 0.83 times book value. That means the market is pricing it 17% below the value of its assets. Translation? You're getting it at a discount. You're basically buying $1 of property for about 83 cents. As for leverage, MLT's gearing ratio is currently 40.7%. That's still comfortably below MAS's limit of 50%, but it is creeping higher. So far, it's manageable, but there's less headroom for aggressive borrowing or big acquisitions unless they recycle assets or raise equity. So, is MLT undervalued? Based on book value and current yield, yes, MLT looks slightly undervalued. But here's the catch. The market is cautious. Investors are pricing in risk from China's weakness, currency headwinds, and interest rate pressures. So while the price looks attractive, the question is whether MLT can bounce back in the next 12 to 18 months. And that leads us perfectly into what's coming next. Part 5. Dividend History. How's the payout? Let's talk about why so many Singaporeans love MLT, quarterly dividends. If you're someone who loves passive income or just enjoys seeing regular payouts hit your account, this one's for you. MLT has been paying dividends every quarter for years, making it a favorite among CPF, SRS, and retirement-focused investors. For the latest financial year, which is FY 2024-25, total dividends came up to 8.053 cents per unit. At today's share price, that works out to a dividend yield of around 6.9%. That's more than what you'd earn from a fixed deposit, CPF ordinary account, or even most government bonds. Not bad for sitting back and collecting income, right? But here's the thing, and it's important. MLT's dividend has dropped for 2 years in a row. Not by a lot, but it's a sign that the REIT is feeling some pressure, mostly from higher borrowing costs, currency effects, and softening rents in China. So while the yield looks attractive now, it's worth keeping an eye on whether MLT can stabilize or grow its DPU again moving forward. Part 6. Why has MLT's share price dropped? Let's talk about the elephant in the warehouse. Why has MLT's share price been falling over the past few years? Well, it's not just bad luck. There are a few real factors at play. First, China exposure. MLT has about 20% of its portfolio in China, and unfortunately, rental income from China has been falling. Due to ongoing trade tensions and a slowing Chinese economy, demand for warehouse space is weak and rents are being renewed at lower prices. That's been a drag on overall performance. Second, higher interest rates. REITs borrow money to buy properties, and in the past 2 years, interest rates have jumped, which means higher borrowing costs and lower distributable income. MLT has done a good job hedging most of its debt, but it's still feeling the squeeze. Third, currency headwinds. MLT earns income from across Asia, including Australia, Japan, and South Korea, but reports results in Singapore dollars. So when the Singapore dollar strengthens, overseas income gets translated into fewer SGD, making the results look weaker, even if nothing changed operationally. Put it all together. Slower rental growth, higher costs, and currency drag equals lower DPU. That makes some investors nervous, causing the share price to drop. but the fundamentals aren't broken. It's more of a confidence issue for now. Part 7. How interest rates affect REITs. Let's talk about something that affects REITs a lot. Interest rates. REITs like MLT borrow money to buy and manage properties. So when interest rates go up, borrowing becomes more expensive, and that eats into their income, which means lower dividends and softer share prices. That's one big reason why MLT's unit price has taken a hit over the past couple of years. So what's happening with interest rates now? At the June 2025 FOMC meeting, the U.S. Federal Reserve kept rates steady at 4.25 to 4.5%. There was some talk of a possible rate cut in July. In fact, Fed Governor Michelle Bowman suggested that a cut should be on the table. But Fed Chair Jerome Powell and other members made it clear they're in wait-and-see mode, and inflation data will drive the next move. So while a few officials are open to a cut soon, most economists now expect the first rate cut to happen in late Q3 or Q4 2025, or even early 2026 if inflation doesn't cool more meaningfully. Why does this matter for MLT? Because if and when interest rates fall, MLT's borrowing costs go down, their profit margins improve, DPU, or dividends, may stabilize or even grow, and investor sentiment could turn more positive, lifting the share price. In summary, the environment is still tough for REITs in mid-2025, but the pressure might ease later this year or in 2026. If you're investing for the long term, the interest rate cycle could shift in your favor. Just don't expect an overnight turnaround. Part 8. So, is MLT a good buy now? So after all the numbers, trends, and charts, let's get real. Is Mapletree Logistics Trust still worth your money? Well, let's look at the full picture. MLT owns 180 properties across 9 key Asian markets, and not just any properties. These are high-quality, income-producing logistics assets like warehouses and distribution centers. It's still paying steady dividends, even with some recent dips. It's trading below book value, which means you're buying the assets at a discount. And if interest rates start to fall later this year or next, MLT's borrowing costs drop, margins improve, and the share price could recover. But here's where we need to be honest. China is still a wild card. Rental reversions there are still negative, and recovery may take time. Dividends have fallen for 2 consecutive years. Not ideal if you're relying on income. And even though MLT has hedged much of its debt, interest rates are still high today, which continues to squeeze REIT margins. My take? If you're looking for fast gains and fireworks, MLT might not be the one. But if you're a long-term income investor, building a portfolio with CPF or SRS, and you're okay with some short-term bumps along the way, MLT is still a solid sleep-well-at-night REIT. It's stable, it's diversified, and it's one of the best-managed logistics REITs in the region. Accumulating slowly, especially at a discount to NAV, could pay off when the rate winds shift and logistics demand picks up again. So, what do you think? Are you already holding MLT, planning to buy more, or still waiting for the Fed to blink? Drop your thoughts in the comments. I'd love to hear from fellow Singaporean investors like you. And hey, if you found this video helpful, give it a thumbs up so more Singaporeans can discover it too. Subscribe to Wealth for You for more REIT breakdowns, dividend insights, and smart investing tips, all in plain English. Until next time, this is Wealth for You, helping you invest smarter, one warehouse at a time. Yes, even logistics can be exciting. Take care, and I'll see you in the next video.